Socially responsible investing is not as simple as putting your money into an SRI fund or an ESG, which stands for Environmental, Social, and Governance Fund. There are simply too many variables. First, with so many ESG funds available, there's 275, there's no universal definition of an ESG fund. Each one has its own set of criteria. Just because the fund has ESG in the title, it doesn't mean it meets your definition of ESG. That was a quote from Jonathan Kovarsnik, Cherokee Investments, in a June 18, 2018 article in USA Today called ESG Funds: What You Need to Know About Socially Responsible Investing. It's important to become very clear about your personal views on social issues, environmental policy, and corporate governance before you start shopping for a fund. Another factor that a person needs to consider is your responsibility to your own financial well-being. Does owning ESG funds help or hurt an investor's bottom line? Well, that all depends. While some ESG funds do a little better than owning an index fund, in my experience, most do a little bit worse. One of the biggest problems is that most ESG funds have much higher fees than their passive counterparts. Vanguard notes the average cost of an ESG fund is 1.06%. Vanguard and Dimensional Fund Advisors, DFA, offer two of the lowest cost SRI funds with costs of 0.28 and 0.18 respectively. That's a lot lower than 1.06. To ascertain how SRI funds fare over time, well, let's compare these two funds with their non-SRI equivalents. Dimensional Fund Advisors specializes in constructing low-cost passive mutual funds based on the research of Eugene Fama, who is the recipient of the 2013 Nobel Prize in Economics. These funds are owned mostly by institutional investors like the South Dakota Investment Council and clients of some fee-only advisors. DFA offers a fund called the U.S. Core Equity 2 portfolio. It holds a broad range of 2,882 U.S. companies, from the largest, like Apple, to the smallest, which are called microcaps. Over the past 5 years, the fund has earned 11.94%, and over the last 10 years, it's returned 11.67%. The expense ratio of this fund is 22 basis points, 0.22, which is about 1% under the cost of most active equity funds. So that's their flagship fund, so to speak. DFA then offers a sister version, an SRI version of the fund, the U.S. Social Core Equity 2 portfolio. It excludes companies that deal in nuclear weapons, tobacco, alcohol, gambling, abortions, pornography, landmines, child labor, stem cell research, or anything that's based in the Republic of Sudan. The fund has a slightly higher expense ratio, 0.28%, due to the cost of actively excluding 18% of the funds, or 530 stocks. 18% of the stocks, I should say. Which I found interesting, that only 18% of those 2,880-some stocks were offending, meaning 82% were just fine. The fund, then the SRI fund, has returned 11.56 over the past 5 years and 11.15 over the past 10 years. Now, that is 0.38% less over 5 years and 0.52, or about 0.5%, a little over 0.5%, less over the last 10 years than the sister fund that invests in everything. Now, while a 10-year return of 0.52% less doesn't sound like much, it makes a difference. $100,000 investment in the SRI fund grew to $287,803 over 10 years, while the same investment in the non-SRI fund grew to $298,597, which was an additional $10,794 and buys a lot of Happy Meals. But take this one. Vanguard's FTSE Social Index Fund didn't compare at all quite as well with its sister fund. A $100,000 investment in the equivalent Vanguard Large Growth Fund earned almost $100,000 more than the Social Index Fund over a 10-year period of time. Wow. So, investing in ESG funds is not going to hurt the companies you exclude or help the overall returns of your portfolio. Yet the value of investing that aligns with your beliefs may still be worthwhile for you. However, and consider this, an even more effective way to influence companies you believe to be socially irresponsible is to boycott them. Refuse to purchase their products or their services. It's going to make a far bigger impact than refusing to own their stocks. So, don't buy Pepsi. Don't buy Coke. Don't shop at Walmart. Don't fill up your car with gas. Things of this sort. Also, if you maintain a more broadly diversified investment portfolio, you may also be able to donate larger amounts directly to the causes that you support. Thanks for joining me.